Hi, welcome to Wise Beyond Bitcoin, your home for the crypto neo news, education, and opportunity. My name is Ryan.
My name is Lucas.
And we're talking about macro things today, all things macro. But before we jump into that, we do want to touch on some of our playlists. We love following the Secret Network. We focus on the privacy metadata layer on Secret and how that makes Secret NFTs so unique and novel, what they can do. We talk about we have playlists on how to start your crypto journey, get a Kepler wallet, get Secret or whatever, swap into whatever you want, how to stake, send, choose a validator, have a whole set of playlists on validators and what the differences are between those and why picking the right validator can matter. We also have a section on cryptonomics news, as well as airdrop crypto opportunities playlist. That's been very active, especially with the IBC, the home for the coolest airdrop ecosystem there is in crypto, I believe. We have a macro outlook playlist, this is going to be a video in that vein. And before we jump into that, we have to make it clear this is not financial advice. We are not giving commercial, legal, financial, any kind of advice. This is just two dudes sharing their research, hoping to educate and to spread the knowledge. So take it all with a grain of salt.
Yeah, with that in mind, we love to show about how to get involved in blockchain and crypto, but at the same time, we show these macro outlooks because there is a lot happening in the world right now, and it's not all bull market, look at this technology rip roar. So we want to remind everyone that whenever you play in blockchain, it's experimental technology, it's emerging, it is high risk, and we're going to touch on some things happening in the world right now. But the reality is that make sure, I would say, you whatever's in crypto for the time being, that you're prepared to watch it go down, and for a crypto winner and for a market winner at that, and prepare yourself.
Don't discount that as being a possibility, right? Strong possibility.
Be involved in crypto, the blockchain, the technologies that you want to see continue to flourish, that you feel will be around for a while, and those for sure there's potential for growth in many places. But overall, when you look at the economy at large and you look at where crypto markets have come and where that liquidity, where that money came from, what's going on in the world right now, and the prices and the supply chain shortages and the things that are happening, it's not ceteris paribus. And we do like to bring that macro outlook picture so that when the markets do correct, and before we go into this, I would just say real quick, I am heavily of the understanding that when people look at prices in DeFi and the crypto markets, the reality is that most of it is funded and built up with institutional money and big money. And as high as this tiny little market cap and all of crypto has gone up, it can have the wind taken out of the sails and can be deflated pretty quickly, as we've seen in the past. So so just have that understanding and awareness when you're getting into these, how volatile and fragile that many of these really are, as exciting as it can be. And let's kind of get into what's causing some of the volatility at large.
Let's do it. Well, we don't always, but we often draw lines between what happens in the traditional financial markets with the crypto markets, right? And it seems to be that there's a positive correlation, such that when the broad indexes are selling off, you tend to see corresponding sell-offs happening in crypto, and that, and it's not always the case, but if you looked at last night at these numbers, there were a lot of red on the screen. You can see that clearly in the last day or so, there's been some profit taking. Now there's been some reversals, buying the dip mentalities happening, but clearly there's a correlation between financial markets and traditional markets and then in the crypto markets. And that you can see that in all of these charts. There's the last day or two, last 48 hours, there's been some weakness in these prices, and even with the bounce back. So let's talk about what's driving some of this price action in traditional markets, and then we can draw conclusions for crypto markets later on. But Well, so we talked earlier in this week. We had a calendar essentially of news events that we were looking forward to, and Friday today we were going to get the jobs numbers out, and they were going to be that everybody's kind of watching that and thinking, well, what's going to happen? You know, what are the is it going to are we going to have more jobs added in February than we expected, or will there be fewer? Right, and what will that number look like? And a lot of trading activity hedges on hinges on what those numbers actually turn out to be. So we got the data today, and it was very good, very, very good. A lot of resilience in the economy, and the focus was on two big numbers. One, the unemployment drop. The headline number dropped to 3.6%, which is really low. I mean, that's historically below the average. What's called long run there's some term for, there's always going to be some unemployment in the economy as people are moving from job to job, but then there's this other element of unemployment which is cyclical, which is driven by, are we in a recession, or is there too much or not enough aggregate demand, so the 4%, I believe, is like the long run neutral rate of unemployment, I believe, is what people would say. So we're below that, right? So we're seeing that this would be a way of saying that there's a shortage of labor when you get to these numbers, right? They're trying. There's employers and businesses want to hire, and there's not enough laborers to go around. And we've heard that. That's been a common narrative, right? So this is all to say that the fundamentals of the labor market look pretty strong. Like if you want a job, chances are you can get one, right?
So
And the other number is this non-farm payrolls increase. This is the sheer number of jobs that were increased in February that were not connected to farming. And so, 431,000. They expected it to be 490,000, but it's still right along close to that expectation. A lot of jobs created last month. So all in all, very bullish in terms of how the economy looks in real terms, right? In terms of just labor market. Go ahead. You had a comment.
You go back to FinViz, and as you were saying, there's a strong correlation between the traditional market and the crypto market. And as you can see, after the major correction and the sell-off, there seems to be a bit of a rebound and a place to correct. And you see that obviously one of the things about blockchain and crypto, it's so thin, it's so young, and there's so much potential for it that you often see it highly exacerbate, whether it's the drop or whether it's the rebound, the growth. You always see this very accentuated reaction.
Right.
That being said, when you come back over here and you see that drop off and you just reported about job growth, why is it when news comes out about strong job growth and less unemployment than expected, why would that news lead to a sell-off? Because traditionally speaking,
Right.
that if you hear news of job growth and ceteris paribus, all else in the market with the way the Fed and everything's working, that's usually good news in the stock market. That's usually price, so why is job growth come out to be bad news?
Well, it's a little counterintuitive, right? You would, like you say, you'd expect the good news to be a kind of a buy the news kind of thing, right? And really, though, it turned out to be a sell the news event, right? People saw that there was a small rally, a small bump, and then quickly selling started. And I think one of the ways to understand that is that we are in an environment where the Fed has just come out of a decade long stimulus program that they have announced they want to unwind. And in the mix of that, inflation has just become a big news item, right? So inflation is a big problem, which is also another reason why they want to unwind that stimulus. And so when you're engaging in this new policy of shifting from stimulating to unwinding stimulus, one of the questions that people watch is how credible is this commitment? How credible is the Fed in their word about hiking rates? Are they really going to be able to do 7.25% rate hikes this year? Is that really going to happen? And so traders are watching that. They're looking for clues to see how credible that plan is, right? Because we've seen in the past, there's been plans to sell Fed assets and to raise rates. And then they went down that path, but it only lasted for a short amount of time and had to shift gears and go back to stimulating. So there's a bit of a cynicism on the part of market participants, like trying to figure out how much they can trust the Fed, how much credibility they have. And
But
so that
even with that,
so with that, they look for things to see, are they going to be able to live up to their promise? And will they have the willpower? That's the other question. Will they have the willpower to continue this rate hike? Because of the fact that we know that rate hikes can be kind of bad for they can be bad investment environments, right? The stock
with all
market
that
likes
playing out, we still know that the initial reaction is job growth means the Fed has room to raise rates. And
that's where I'm going to. Yeah, that's the point. So this is a way of basically understanding that if they do want to do this, the environment will support it because how strong labor markets are. The way to think of it is if you had a weak labor market and you were about to engage in a rate hike protocol or regime, then that would further weaken the labor market. And so if you're starting from a weak place, how much pain are we going to tolerate? Because there's a political dimension to this. Unemployment starts to become a problem, food stamps use starts going up. You get foreclosures, and all of a sudden you got Occupy Wall Street. You have protests. You have maybe riots. It becomes a question of how much pain can you push onto people without them, saying enough's enough. I don't want this anymore. And then the political will to continue the rate hike evaporates, right? But in a context where the labor market's strong, then it can be sustained without the pain, right? So I think that's what you're seeing is people understanding that, hey, the environment will sustain these rate hikes, and inflation continues to be a problem. We're going to touch on that in a minute. So the narrative for why the Fed would continue to do this is continuing, and their credibility is supported by that.
We've been following up the Fed and their plans and why they are postponing rate hikes. And when, like you said, when they come out with news saying, hey, look, the unemployment rates dropped, the economy is looking strong, they've already said that's what they're waiting for. They've already said that's what it's going to take in order for them to be able to justify raising the rate. So that news alone does give them the reasoning to start that program, that process. And like you said, with inflation, we've got more news to help justify.
Yes, exactly. And let's check that out. So we see that inflation is still a problem, right? So we have some numbers to go through here. We're looking at 40-year highs. That's one of the takeaways. So the consumer price index, that's one of the main indexes we look at, and it's tracking consumer prices, and it is at 6.4% for the last 12 months, and that it's ticked up from 6.2%. So the numbers keep getting worse. That's one thing to look at. And then you have that was the personal consumption index. Now we look at the consumer price index is at 7.9%, which is that's really high. And you can look, if you're curious of what these things measure, the CPI, the consumer price index, excludes food and energy, and the consumer index does not. So that's why you'll see the differences in the inflation rates. They're measuring different things. And then you have PCE and core. Yeah. So they're both telling the same story that, hey, we've got a problem with inflation. And so this is all to say that the inflation is getting to be out of control or a problem, and the labor market's super strong. So both of those are pointing towards, there needs to be a policy response, rate hike, is some sort of a selling off the Fed's balance sheet, whatever it is. That there's clearly in the economy, there's some what you would say, they're not slack. It's the opposite of slack. There's shortages, right? There's like a shortage of labor essentially. So this is all to say that the economy is strong enough to sustain the rate hikes, and in many ways is asking for it with the inflation rate. So all in all, the chances of this continuing, this rate hike continuing for the foreseeable future are strong. And that's why you see the response on the traders selling, because risk assets like stocks and gold is another one. They're not going to do good in a rate hike environment. You can see gold today took a 1.5% off the table. We were nearing $2,000 a week ago, or at $2,000, and now clearly the narrative is shifting that the rate hike is coming, right? And that's what we're looking at. And here's another article pointing to the same thing, talking about how there's been a lot of criticism in the last few weeks, month or two, that the Fed has been too slow to start the rate hike. We've been lots of talk about it, but they should have engaged in it earlier. And so the thinking is they're now behind the curve, and when they're behind the curve, they have to increase the aggressiveness with which they're raising rates. So you go from 0.25% to 0.5% maybe. And the problem with that is that the more aggressive you are with these rate hikes, the greater the chance that you're going to actually cause a recession. Because what the Fed's trying to do is take an economy that's been soaring high from stimulus, like a plane, and they're going to try to bring it softly, like a soft landing, where they can land this thing, right? And you don't do that by slamming on the brakes, because that's going to create a it's going to drastically, you're going to create a nosedive. It's a drastic change. So they're trying to be artful about it, and kind of gently tap the brakes and get this thing at it from a high altitude to a slightly lower altitude, so they can gradually land the plane. And there's been talk about the last time they accomplished this. I think it was 94 when they did a soft landing. So it is possible to do this. But the question is have they waited too long? And if so, will they have to play catch up essentially? And if that's the case,
it's also in the atmosphere that we're living in, with sanctions of nations and the supply,
the war.
Changing. There's a lot of different factors at play. It's not ceteris paribus in business,
right?
As
it's
usual.
Not simple.
No.
So we're in uncharted territory in many ways, and we'll have all these articles and links at the bottom.
I would even say, if you think about it, this is an aside, but the last 20 to 30 years are like this jubilee of free trade, where you saw interoperability, worldwide access to travel and to goods being shipped, and the price,
money flowing,
price, and the price. And it's strange. It just seems kind of like a throwback to watching all of this change in front of our very eyes at these higher up political decisions, where the whole map, the whole capital structure overnight is almost changing, and prices are changing. And this it appears like it's just the beginning of going back into this Cold War type
this fragmented kind of world, right?
Right.
Like a pre-globalization. This is the post globalization world we're going to be moving into. Maybe not. We'll see. But it'll definitely be unique and different from what's come before.
And isn't it strange, juxtaposed to one of the most decentralizing and technologies known to man that we can think of, with blockchain and crypto, bringing people together with stronger, more secure networks worldwide.
It's funny because as crypto helps decentralize the links between people in the cyber world, right? It seems like the things that are happening in the meat space world, whether it's legislation or trade or war or sanctions, are moving in the other direction. We're moving away from integration towards this more centralized, siloed kind of way of interacting with other people in other parts of the world. Meanwhile, the technology in crypto is tearing those boundaries down and decentralizing things. So it's like it's two different forces moving in two different directions, and I'm happy in different communities.
They're two different communities. The crypto community at large is very small. The reality is most of it's built up. When people look at the numbers, most of it's built up on Coinbases and Krakens and Michael Saylors.
Binance.
It's huge money from big institutions. The reality of the decentralized networks of people that are involved in blockchain and crypto and DeFi are so small. It's like if you're talking to someone who has an NFT artwork in Ukraine or Russia or China or Canada, everyone is equally excited about the decentralized nature of blockchain and crypto, and have real no say or connection to what's going on.
The rest of what's happening.
The bombs being dropped around them,
they're kind of held hostage to the decisions of others in many ways.
We've actually, through crypto, known people, NFT creators and artists who are suffering in the Ukraine or are in Russia that are trying to help others. I mean, it's actually a very interactive, beautiful community. So it's a
Indeed.
different world than what you see in the mainstream communication in that traditional world. So it is
And
funny to
this is a
see.
good segue into that, because
Here you go.
we this whole macro series is about us talking about things happening in the broader economy and how they're going to impact crypto, right? And how what the links are between these worlds. And this is a big theme in that story, right? The regulation, the attempt of various nation states to control through various tools who has access and how people are trading, and how these movements of flows of energy occur, and whether or not they can get their piece of it, right? That's a big element of this. So we've been talking about the macroeconomic threats to the crypto bull market continuing, right? Whether it's supply chain or inflation or the Fed or war or whatever pandemic stuff that's lingering. But there's another vein or another channel where we're seeing that the future for crypto might change the way it looks going forward, is right here with what the EU is doing.
DeFi as we know it. DeFi
Yeah.
has barely begun to grow in the last few years, from Uniswap, AMMs, DEXs,
Mm-hmm.
providing LPs from decentralized worldwide communities that may have different wars and different issues going on, but to allow this new technology to grow and flourish. And it seems now there's being an early attack or a constriction on the research and development, because really I feel it's preventing, it's stifling new technology and research and development in a market that is so young and immature. And I'm talking about blockchain and crypto. It's such a baby compared to, we've talked about shadow banking and what goes on, and we've got videos on that. But if you look at the fraud and the problems in the traditional banking sector and with the size of sums in nation states, it really makes the whole crypto market look very infantile, very small and fragile. And on top of that, when you look at how much of the crypto market is actually government money and state money and institutional money, it's kind of silly to to look at blockchain and crypto as anything else, really, because most people don't know anything about blockchain and crypto. Most people don't know what a DeFi wallet is or how to operate it.
Right.
So to come in and act like it's some big threat to the system when it's
not clearly no.
To learn.
Yeah. Well, let's talk about this part of the story. So there's been an amendment that's introduced in the EU. I believe it's a proposal that passed. An amendment was added to it, which passed. And what it does is makes it basically it forces crypto services and users to use KYC requirements when they're doing any kind of transacting in any way in crypto. So everything else would be illegal, essentially. So that means that MetaMask or Trezor or Kepler or any of the wallets or exchanges that don't require KYC, well, looks like, we don't know. We're going to wait on the details, but it looks like they're going to be banned for anybody in the EU.
What's funny is these are brand new technologies that have just been created to allow people to even experiment and interact with this new
to your point,
Web 3.0 that most people don't even understand. Even these companies are creating, look, now you can look at an NFT, this new contract that was just developed on blockchain. They're just beginning. So to treat them in the same way that you treat, this is how you should treat, I guess, a Coinbase or a centralized exchange or a bank or an intermediary. Like you mentioned earlier, if you're in the business of buying crypto and selling it and cashing, and absolutely, you're part of that system and that commercial realm where, you got to, but
pay your taxes.
If you're sitting here and you're spread out and you've been not a victim, you've been able to learn your lesson with all the rug pulls, because let's be real, blockchain and crypto is such a highly experimental technology. If you buy an NFT, be ready to just enjoy looking at that JPEG and never being able to turn around and sell it for a profit, because most likely you're not going to profit off much of an NFT, right? So enjoy using it to play the game or be a part of the community, and
unless you were happy to be lucky and board Ape Yacht Club or investor or something like that. Yeah.
And even then you'll find a lot of the people are so tickled that what grows the value is the people not selling it and holding on to it and being, but the reality is that there's a lot of opportunities to lose money in blockchain and crypto and in DeFi, more ways to lose than to earn. I know
it's just as easy to lose your money as it is to earn it,
and to miss your private keys. And when you look at the banking system has FDIC insurance. They're there. If you send something and didn't get through, then they'll make sure you're.
They created the currency that's being, or they very, in some ways, are responsible for the whole infrastructure, whether it's legal tender laws or SWIFT or the chartering the banks or X, Y, and Z. You fill in the blank. There's a lot of ways that this SEC protections, the Consumer Financial Trade Commission protections, like there's a lot of services embedded in the mainstream financial system that have to be funded. You don't just say, oh, look, thanks for the insurance. Don't ask me to pay for it. No, you're enjoying the insurance. You're enjoying all these things. You're going to pay for it. Right. It's like,
I would even go so far as to say, and I had it written down somewhere before, we could do a whole separate video on this, but for those people that are involved in Web 3.0, and I have no technical background, I'm not good at that stuff. I mean, it takes a lot for the great production that you see right here to record a Zoom and put on YouTube. But for those that understand how Web 3.0 works, I forgot where I was going with that. It happens.
Well, it doesn't require centralized entities to maintain, right?
No, it does not. It does not.
That was my point, is that if you're enjoying the benefits of if you're enjoying public goods in whatever form they come, then you should be prepared to pay for them. But don't come to me asking me to pay for something you're not going to give me. Like, I don't get charged by McDonald's for times I didn't go drive through the drive-through.
That's right. That's where I was going with it. So the idea is that you don't have to be a Web 3.0 guru and understand that to realize the scams that have been going on. I mean, there have been so many scams on YouTube, apparent scams, and even Steve
Twitter
was like, hey, they're doing this. So YouTube is a highly centralized system that has a lot of control of removing accounts or removing videos and doing whatever they want.
Yeah.
And yet you've got these obvious crypto scams preying upon people that are just obviously just getting into crypto and think it's some kind of
the first time. Yeah.
And they're losing. And you've got other Web 3.0 on Google and these major hacks through Google and other major centralized. So where is the SEC? Where are all these great protectors of fraud and law? Because really it's a lot of scammers out there that are hurting innocent people that are getting into a brand new technology that is very young. And
well, I think I would say what you're saying just in a different way. I'd say, okay, we can talk about various regulations that you guys may want to impose, but before we have that conversation, what are you bringing to the table? Like maybe you point out the BitConnects and the rug pulls before talking about like taking your chunk of the pie. Like you don't go into a business that's been running for 100 years in your first day and say, oh, I need to have a share of everything you guys have built. It's like, well, no, unless you built it, unless we had that agreement, you don't have a claim to it, right? It's like, it's not yours. And I feel like that same thing is true here. It's like, it's very presumptuous to pretend that they're needed at all. I mean, the crypto community discovers rug pulls, outs hacks, catches people. There's actually crypto gurus, people, blockchain analysis companies that are doing the work of an SEC, of a CFTC, and they're doing it, without their legal, without their legal benefit,
Well,
or what am I trying to say here? Without any official capacity, they're doing it just as a private actor. So if these private actors are able to do all this, why can't the regulators come up and show us what they can do, right?
well, and we just did a video on Russia and how much liquidity is even in crypto, because it was a Warren was stating, is this some hotbed for illicit activity? And you had the people behind these mixers saying, no, there's physically not enough liquidity in blockchain or crypto
To do what you're talking about,
to do
right?
what you're talking about. So to come at this and act like it's this big threat when the technology does not allow literally, if all the evil money laundering people in the world were like, we're ready to launder all of our money with a blockchain and wallet now, there's not the liquidity to do it.
No,
And
but
so
you know what? Where there is the liquidity to do it, in their system, in the
in
shadow banking system, in the traditional system,
it's already been
you know,
declassified that it's
right?
going on. And some people, so the idea is when you've got like trillions of dollars in known laundering taking place in the system that you've created, your monetary system, your
Yeah.
fiat system, why not that be the focus of your power and what you're trying to stamp out and regulate with all the KYC?
Well, I can answer that.
Instead of turning around while that's going on. And what's even more presumptuous, if you listen to like the World Economic Forum, you'll listen to the people who will sit there and say, well, we've got it all figured out with this new CBDC, this new digital currency. It's like, what? When have you ever had it figured out? Like, we're
Right.
literally we're rolling down an avalanche of an economy that's fractured and breaking on this financial system that everyone's been glued to. And now you're saying, oh,
We got it figured out. Yeah.
we've got a new one, and this one's going to be even better than before. It's like,
Hold on. Yeah.
hold on a
Don't
second.
do me no favors.
Don't do me no favors. Grab yourself a Web 3.0 wallet. And why don't you add some?
Yeah. But I would go back to what you were saying. Like, so there's this huge untapped ecosystem called the shadow banking system, where billions and trillions of dollars flowing around, without regulation at any, really hardly any level. And then we know through the Panama Papers and the Pandora Papers that there's large amounts of money offshore hidden in different jurisdictions. And this is all part of the official system. And yet we're going to spend all of our time coming up with legislation to go after the few private wallets and DEXs and AMMs that do exist outside the KYC establishment, which is very small in crypto. We're talking about, fractions of the total. Like you say, most of it's institutional money, and that is KYC, AML, regulated. So how can you understand that? Well, there's two things I would say. One, going after the small fish is be a lot easier. They won't have the money for the lawyers and all that, right? So there's that element too. It's easier to get money from people who are not as politically connected as somebody who maybe have an offshore account, right? That's a much harder mountain to climb. But then the other thing you think of it is that there's a class war angle to this as well, right? So, and I don't want to get too deep into that, but money and class war are two subjects that are intimately related, with the way money comes into being, how it's distributed, who gets it first, how that impacts incomes, and what the class dimension is there. So I would read this in that same vein.
And if you want to know more about it, subscribe and hit the notification bell, because we've got topics on Bitcoin maximalism and blockchain, crypto, and war. And we've talked about Cantillon effects, which is what you're alluding to here. So
Yep.
the reality is what role, if blockchain and crypto is a digital money or a basket of different digital monies that people can choose from, what role does that, should it play in the capital structure, in the markets that we see how things are funded? And should people expect it alone to make a change, or what might,
or it will have to go beyond, right?
absolutely.
We're going to talk about that. We'll touch on those issues in a coming video.
But as far as why the job market growth would send the market down, as well as inflation numbers and rate hikes, and this is where we're at. And of course, what goes on in the traditional market continues to be highly correlated with the crypto market. So there's your connection there. There may be a decoupling one day, maybe, but if
don't bet on it.
don't bet on it, don't bet on it
Yeah.
anytime soon, at least.
Yeah,
So yeah, I would say that we covered this one pretty well.
I think so too.
Until the next
It's
time, have a
always,
beautiful day and namaste, y'all.
thank you.